Silver closes the year at 76.28 per ounce. That single number should terrify every central banker on earth, not because it's high, but because of what it represents. The largest single-year percentage gain in precious metals since 1979, a 162% surge that obliterated every expert prediction. And here's what nobody is discussing. This isn't the end, it's the setup. I've spent months analyzing the historical patterns that precede monetary system breaks. Every time, without exception, the same four-stage mechanism plays out. And after studying what happened in 2025, I can tell you with mathematical certainty where we are in this cycle. We just completed stage 3, stage 4 is 2026. Let me walk you through exactly what happened this year, because the media missed the real story entirely. They focused on the price. They should have focused on the pattern. January 1st, 2025. Silver opens at $29.87 per ounce. Industrial. Boring. Ignored. The same metal that's been range-bound for years while everything else inflated around it. But something was different this time. Something the algorithms couldn't see and the institutions didn't understand. The first signal came in March. Not from markets, from mines. Global silver mine production dropped 3.2% year over year, third consecutive year of decline. But here's what caught my attention. It wasn't geological, it was political. Environmental regulations in Peru, labor strikes in Mexico, permitting delays in Canada. The supply side was being systematically constrained. The second signal arrived in May. China announced strategic metals review for their export policies. Industry insiders knew what this meant, but the market didn't react yet. By June, something unprecedented started happening. Physical premiums began decoupling from paper prices, dealers reporting 6 to 8 week delays, mints struggling with demand. But silver futures stayed pinned below 32. That's when I realized we were watching the same mechanism that destroyed the Hunt brothers in 1980. Except this time, the system was on the other side. July brought the institutional awakening. BlackRock launched their largest precious metals ETF since 2008. Fidelity followed, then Vanguard. Suddenly, pension funds and sovereign wealth funds wanted exposure. But here's the critical detail everyone missed. They weren't buying paper silver. They demanded physical delivery. August 15th, the day everything accelerated. President Biden signed the Critical Minerals Security Act, officially designating silver as a strategic resource. That wasn't policy, that was panic. When governments start hoarding your asset class, you know scarcity is real. September delivered the technical breakthrough. Silver finally breached $40 and held. Options market exploded, short covering cascaded. But the real violence happened in the physical market. Registered silver at COMEX dropped from 110 million ounces to 43 million in 6 weeks. That's not normal demand, that's a run. October brought the geopolitical catalyst. Russia announced they would back their new BRICS trade currency with a basket of commodities, including silver. China immediately followed with their own announcement. 2 billion people suddenly had monetary systems that valued silver. Paper markets hadn't priced this in. November 28th marked the technical break. COMEX suffered a cooling system failure during peak volatility. Silver was boring for 15 years. Stage 2, recognition, check. Institutions started accumulating in 2025. Stage 3, acceleration, check. We just witnessed the fastest precious metals rally since 1979. Stage 4 is 2026, and stage 4 is always the same. The paper market breaks. What I'm about to show you will change how you view 2026 forever. Because what happened to silver in 2025 isn't unprecedented. It's happened 3 times before. Same pattern, same outcome. And every time, the people who recognized it early made generational wealth while everyone else stood confused. Let me prove this pattern to you using 3 historical moments that mirror exactly what we're witnessing now. The first blueprint came on August 15th, 1971 with the Nixon Shock. President Nixon closes the gold window, ends Bretton Woods, declares that foreign governments can no longer exchange dollars for gold. That wasn't policy change, that was system failure. Why? Because France and Germany had been demanding physical gold delivery for their dollar holdings. America didn't have enough gold to honor the promises. The result? Gold explodes from $35 to $850 over 9 years. Silver follows from $1.30 to $49.45. Both metals telling the same story. When paper promises exceed physical reality, price reflects scarcity, not speculation. Here's what matters for 2026. Nixon didn't choose to end gold backing. He was forced to. Foreign banks were draining U.S. gold reserves. The paper system broke under physical delivery pressure. Sound familiar? The second blueprint emerged in January 1979 with the Hunt brothers' accumulation. Nelson and William Hunt start buying silver, not trading, buying, everything available. They accumulate 200 million ounces. Their thesis? Inflation is destroying the dollar, Silver is real money. Industrial demand is growing. Mine production is flat. January 1979, $6 per ounce. January 1980, $49.45. That's 724% in 12 months. But here's the lesson everyone misses. The hunts didn't cause the shortage. They exposed it. For decades, the silver market had been flooded with paper contracts, futures, certificates, derivatives. But when someone demanded actual physical delivery at scale, the system couldn't deliver. COMEX panicked, created Silver Rule 7, banned new long positions, forced liquidation only, changed the rules mid-game to save the exchange. The hunts got crushed. But the physical shortage was real. The $49 price was real. It took changing the entire game to stop it. The third blueprint appeared in September 2008 with the Lehman Brothers collapse. The mortgage crisis exposed the same mechanism in a different market. Banks had created trillions in paper claims on underlying assets. When investors demanded the actual assets simultaneously, the system couldn't deliver. Bear Stearns collapsed. Lehman followed. AIG needed bailout. Gold was $720 in October 2008. Stage 1, stability through paper multiplication. Authorities create confidence by issuing more promises than physical assets. Prices stay suppressed. Everyone trusts the system. Stage 2, recognition of imbalance. Smart money realizes paper claims exceed physical reality. Early accumulation begins, prices rise slowly. Stage 3, acceleration and stress. More participants demand physical delivery. Inventories drain, paper markets lose control. Volatility explodes. Stage 4, system break. Paper market suspends delivery. Trading halts, rules change. Physical price disconnects from paper price. Now apply this pattern to silver in 2025. Stage 1 was complete before 2025 started. Decades of paper silver creation. Futures markets 100 times larger than physical. Prices suppressed below industrial demand. Stage 2 happened in early 2025. Institutional recognition, ETF inflows, government strategic designation, smart money accumulation. Stage 3, it was 2025's dramatic rally. Physical premiums exploding. COMEX inventories draining. China export restrictions. Elon Musk warnings, market stress obvious. Stage 4 is 2026. But here's what makes this time different and infinitely more dangerous than before. The Hunt brothers were two individuals fighting the system. They used leverage. They could be crushed by rule changes. Today's buyers are different. Sovereign wealth funds, central banks, industrial users who need silver for production, pension funds seeking inflation hedges. You can't change rules on everyone simultaneously. You can't margin call the Chinese government. You can't force Tesla to stop making electric vehicles. And here's the most dangerous difference. In 1980, silver was mostly monetary. Today, it's industrial. Solar panels need silver paste. Electric vehicles require silver contacts. 5G infrastructure uses silver circuits. Data centers need silver components. When the paper market breaks this time, it's not just monetary. It's technological. Industrial users will pay any price because production stops without silver. That's not speculation. That's physics. The pattern is identical. But the scale is exponentially larger, and the consequences are systemic. 2026 isn't just another year. It's stage 4 of a mathematical certainty. Here's what the data tells us about 2026. And here's what the data does not know it's telling us. Goldman Sachs projects 85-95 hours by year end, 2026. JP Morgan forecasts 90-110 in range. Bank of America estimates $95 to $120 in an inflationary scenario. These are the conservative estimates, the ones banking on system stability, the ones assuming the paper market holds together. But I've been studying something else. The hidden indicators that preceded every major silver breakout in history. The supply mathematics are brutal. Global mine production, 830 million ounces annually. Declining for 3 consecutive years. No major discoveries, no new projects coming online. Environmental restrictions tightening globally. Industrial demand, 670 million ounces in 2025. Solar alone consumed 200 million ounces. Electric vehicles added 85 million. 5G infrastructure demanded 45 million. AI data centers required 25 million. The math is brutal. Demand exceeds supply by 160 million ounces annually. We're mining 830, consuming 990. That deficit comes from above-ground stockpiles, and those stockpiles are evaporating. COMEX registered silver dropped from 350 million ounces in 2020 to 43 million today. That's an 87% decline in 5 years. At current withdrawal rates, COMEX hits 0 deliverable silver by March 2026. But here's the hidden mechanism that the official data misses. China's January 1st export licensing isn't just policy change. It's weaponization. They're not restricting silver exports to control their market. They're restricting exports to control everyone else's market. China produces 15% of global silver, but processes 60% of all silver worldwide. Their refineries, their technology, their export infrastructure. When they require licensing, they're not just limiting raw silver exports. They're controlling the entire global supply chain. Industrial users outside China face a choice: accept Chinese licensing terms and pricing, or develop alternative supply chains that don't exist. Tesla, Apple, Samsung, every major solar manufacturer, they're all dependent on Chinese silver processing. Here's what happened in Q4 2025 that nobody noticed. Sovereign wealth funds increased precious metals allocations by 340%. Norway's fund bought $2.8 billion in silver ETFs. Singapore's GIC acquired strategic silver positions. Saudi Arabia's PIF established a precious metals division. These aren't momentum trades. These are generational positioning decisions. Sovereign wealth funds don't chase returns. They position for systemic change. The technical setup reveals even more danger ahead. Silver's gold ratio sits at 72, 1 historical average, 15, 1 mean reversion math suggests silver should be 208 per ounce based purely on gold's current price. That's not speculation. That's statistical probability. But here's the dangerous part. Every time the ratio exceeded 60.1 in history, silver didn't just revert to mean. It overshot violently. 1979, 1980, ratio went from 75.1 to 15.01 in 18 months. 2008 to 2011, from 80.1 to 30.1 in 3 years. Current ratio at 72.1 suggests silver is either massively undervalued or gold is in a bubble. Given industrial demand fundamentals, it's not gold that's wrong. The catalyst timeline for 2026 becomes clear when you map the pressure points. January 1st, 2026. China export licensing begins with immediate supply disruption. February. Solar manufacturing hits peak seasonal demand while Chinese restrictions create shortages. March. COMEX registered silver approaches zero and the exchange considers rule changes. April, May. Industrial users panic buy physical silver and premiums explode. June. G7 designates silver as critical strategic mineral and government stockpiling begins. July, August. Paper market stress becomes obvious as ETF premiums disconnect from futures. September. Federal Reserve forced to address commodity inflation and monetary policy. October, November. Currency crisis, potential as silver breaks $200, questioning dollar stability. December. System either adapts to new silver reality or experiences full paper market break. Looking at the unthinkable scenarios ahead, the best case for 2026 shows silver reaching $150, $180. Volatile, but manageable, with industrial users adapting, paper markets adjusting, and the system surviving. The probable case sees silver hitting $200, $250 with paper market stress obvious, rule changes implemented, and physical premiums exploding to 30, 50% over paper. The worst case scenario breaks silver past $300 with paper markets suspending delivery, trading halts, and physical disconnecting entirely from futures, disrupting industrial production globally. The mathematics point to probable case. The historical patterns suggest worst case. And here's what terrifies me most about the data. None of these projections account for the one variable that changes everything: mass psychological recognition that the system is breaking. When that happens, price becomes irrelevant. Because at any price, you can't buy what doesn't exist. January 3rd, 2026, 3 days from now, China's export licensing takes effect. That's when this mathematical certainty becomes market reality. Picture this eruption mechanism unfolding in February 2026. First, Solar announces they cannot source enough silver for Q1 production. Stock drops 15%. Tesla follows. Silver shortage limiting Model Y production. Every EV manufacturer realizes they're competing for the same finite resource. That's the moment. When industrial panic meets investment demand, when the Hunt brothers scenario plays out with sovereign wealth funds instead of Texas billionaires, the price cascade that follows becomes unstoppable. Silver hits $100, then $200, then $300. But unlike 1980, they can't change the rules. The buyers aren't speculators using leverage. They're industrial users who need silver for production. Governments protecting strategic interests. You can't margin call Tesla. You can't force Japan to stop buying strategic minerals. COMEX will try their system response. Margin requirements will increase. But when registered inventories hit zero, you can't deliver what you don't have. That's when the paper market breaks. When futures settle in cash instead of metal, when premiums between physical and paper silver go from 5% to 50%. This represents historical certainty, not prediction. This is pattern completion. Every fiat currency system in history has faced this moment. The Roman denarius, the German Reichsmark, the Zimbabwean dollar, the US dollar has been pure fiat since 1971, 54 years of expanding debt, 54 years of monetary inflation. Silver at $76 isn't expensive. It's the first honest price discovery in decades. You have 72 hours to make your choice. Before China's restrictions take effect, before industrial panic begins, before stage 4 completes, you can wait for more confirmation, or recognize that mathematical certainties don't wait for comfort. The window is closing. COMEX inventory is at 43 million ounces. China controls global supply chains. Every fiat currency eventually faces this moment. After 54 years, that moment is 2026. What do you think will happen when China's silver export restrictions take full effect in 72 hours?